this is certainly an 18-month window where there's more risk to slowing the train than there have been for the past few years. But that I generally will take the under on how much it's going to slow by.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. One of the biggest forces boosting both economic growth and asset price appreciation over recent years has been the explosion of higher fiscal deficit spending. Today's guest, analyst Lyn Alden, predicts we'll be stuck with these large deficits for a long time to come, often repeating in her writing that, quote, "nothing stops this train." Well, why? And if indeed so, what are the implications for investors? And furthermore, with a new U.S. presidential administration publicly committed to reducing government spending, is the train truly unstoppable? For answers, we'll ask Lyn directly. Lyn, thanks so much for joining us today.
Happy to be here. Thanks for having me.
Thanks, Lyn. Thrilled to have you here. My audience is completely thrilled when I announced that you were coming on X a few days ago. People just went bonkers. So hopefully we're going to give them everything they're looking for here. Before we kick off, though, Lyn, I just want to thank you. In addition to coming on for this interview, you've kindly agreed to be one of the featured faculty at the upcoming Thoughtful Money Spring Online Conference on Saturday, March 15th. And I very much appreciate your involvement in that. We're going to speak at that conference specifically about your thoughts and recommended strategies for how investors can protect against the purchasing power of depreciation of fiat currency. I know there's 1,000 other things we could talk about, but given everything else that's being talked about in that conference, I think that's a really good use of your expertise. But again, I just wanted to thank you for that. People are super excited about it.
Happy to. Looking forward to it.
All right. Okay. Well, look, lots and lots of questions here for you. But if we can, let's start with the intentionally broad question I like to start these interviews off with, just so folks can think, sort of see through your eyes in terms of how you see the macro world. What's your current assessment of the global economy and financial markets?
I think I would sum it up with volatility is back. I kind of viewed macro as somewhat boring over the past 2 years or so. I think ever since we had the regional bank crisis in early 2023, and that fire was put out, we've been in a fairly linear stretch of macro. Doesn't mean that there's nothing that's happening, but that things have generally been on roughly autopilot for about 2 years. And with the new administration and kind of the rapid flurry of kind of executive orders and other presidential actions, we're back in a period of uncertainty, higher volatility between currency pairs. And then, of course, that has implications for asset prices. So I think the main thing is that uncertainty is dialed up. Things can change. Like you can have a much bigger position change in, say, a given month in this new environment than it would make sense to have over the past year or two, where trends generally just kept going in a certain direction.
All right. There's that old saying, I think by Lenin, and I'm probably murdering it, but it's something like there are decades where nothing happens, and then there are years where decades worth of activity happens, something like that.
Exactly. Yes.
Okay. Yeah. All right. So that's I mean, I guess you're relating to macro, but I guess you said volatility. I mean, I guess that's sort of what you mean for markets, right? Markets have kind of had a relatively smooth one-way ride since the start of 2023, and you think things could become more volatile going forward. They certainly have started out as such this year.
Yeah, in general, asset prices, well, a lot of them were kind of on autopilot, but also just background liquidity effects, kind of trends that were continuing from one quarter to another without major like rapid changes. Whereas now, in the first half of this year, we're already looking at obviously policy shakeups, but then also we could have liquidity pivots and things like that later this year as well. So I think that there's a number of things that kind of represent trend shifts that we're currently going through.
Okay, well, why don't we just dive into that then? So I've talked about liquidity with a number of people on this channel, increasingly recently of late. We probably talked about it in the past too, Lyn. But in many ways, you can make an argument it's probably been the most important factor, if not one of the most, maybe the most important factor, and just sort of explaining why we didn't go into recession as everybody thought we were going to starting 2023, and why the markets have had great back-to-back 20+% years. And it's interesting as people think about it as, Well, and this has been a tightening cycle for the Fed, right? So the pool's actually been getting drained. But no, I remember talking with you actually, and I want to give you kudos for this. This was probably over a year ago when I was talking about how the Fed had hiked interest rates, at the most aggressive pace that we've seen in our lifetimes. We were hanging out at higher for longer. We were talking about potential lag effects from that. But at the same time, on the fiscal side, sort of saying the Fed looks like it's jamming the brakes. The fiscal side, though, is jamming the accelerator. We talked a lot about that. We'll talk more about it today. Um, and I asked you, which did you think was going to win out? And you said, I think the fiscal side is going to win out. And I think that has been proven true. The asterisk I want to point next to that is we're finding out liquidity-wise that the monetary policy wasn't really even as tight as we thought it was. Because yes, they had hiked interest rates and they had started QT, but they'd also been draining the reverse repo program along the way. I mean, there's the BFTP program that the Fed put together after the banking crisis you mentioned there. So there actually were things that sort of on the net were creating net easing or net positive liquidity as opposed to draining the pond. So I guess where I'm going with all this, Lyn, is A, do you share that assessment that liquidity has been one of the most explanatory factors of what's been going on? And if you do, then let's get into what are some of the things that could change that. Because yeah, there's some potential policy changes, as you mentioned. There's also things like the approaching wall of debt refinancings that's coming up here. Even the U.S. Treasury is going to have to refinance something like $10 trillion worth of debt relatively quickly, and that's likely going to be at higher rates. So those refinancings could act like liquidity sponges, should act like liquidity sponges. So, anyways, let me take a beat here. But do you think liquidity has been as important as I think it's been? And if so, then we'll talk about these other factors.
So I do. That's the short version. And I think that's part of why I refer to the last 2 years as kind of boring in macro, because we've had a fairly stable and helpful liquidity environment. So if you go back 3 years to 2022, there were many of us that were bearish at the time because we had Fed tightening, we had fiscal tightening, kind of all occurring together. And we had purchasing manager indices rolling over, various economic indicators rolling over, high price of oil, all sorts of factors. And what really kind of changed is that by the end of the year, and especially in early 2023, we started to see the Treasury offset some of the Fed's liquidity drain. So the Fed was still doing quantitative tightening, was still holding rates high, but the Treasury began issuing more of its debt as T-bills, which are cash-like. It's closer to money printing than issuing at the long end of the curve. And specifically, like you point out, they had over $2 trillion in the reverse repo facility. We can think of that as extra QE. They did so much QE that banks, just because of their kind of regulations, they can only actually hold so much deposits. They can only hold so much liquidity. It's kind of like a cup. If you pour enough in, eventually you reach the brim and no more liquidity will fit in there. And so the liquidity spilled out into the reverse repo facility. And so that's all like a pool of extra liquidity if you can get it out. And one of the easiest ways to get it out, issue a ton of T-bills. And then money market funds start buying those T-bills and pulling that money out of reverse repos and back into the banking system. And so for like 2 years, the Treasury's been accommodated for liquidity by issuing more at the front end of the curve and pulling money from reverse repos back into the system while the Fed's doing QT. Um, and especially, from the regional banking crisis and onwards, we've been in this kind of fairly offsetting liquidity environment. Some of the potential changes ahead. One, we have a new Treasury Secretary who has been critical of that practice of issuing debt at the short end of the curve. So we could see them try to lengthen that average duration. So that has different ramifications for liquidity. In addition, the reverse repo facility is mostly drained. So most of that 2 trillion has already been used. At any given time, there's 100, 200 billion left, sometimes less, and that's draining down. And so we might have to see by the end of the year the Fed come back and go back to balance sheet increases, or at least no longer decreasing their balance sheet. And that could be a turbulent process because they might want to run into some liquidity constraints before they make that handover. And then in addition, the dollar index is a big component. So a lot of what I talked about there was domestic liquidity, but when we look globally, of really, we have to see what China's doing, what's Europe doing, what's Japan doing, what are these kind of major currency blocks doing, first of all, and then number two, how's the dollar faring against its other currencies? Because the dollar is the unit of account of most cross-border debt, and when the dollar is hardening versus other currencies, it generally means that liabilities are strengthening relative to assets and cash flows, which obviously can be very limiting for a lot of those types of entities. So that's kind of been the liquidity headwind, especially post-election, is the dollar. So I'll stop there, but basically that we're seeing some of an ending perhaps of some of these 2-year trends and a new set of trends emerging.
Okay. So let's let's go talk about the new trends that are emerging that have your attention most right now. And where I want to go with all this is, okay, we've had this rising tide, right? That if you're an investor, what's not to like, right? Everything goes up, economy does okay, we avoid the recession, it's the no landing world, right? So, the average investor probably loves the liquidity, right? Um, are we entering a period now where the tide is simply no longer going to rise, but it's a more stable system? Or are we entering a future where the tide might start draining and asset prices actually could come down and the joyride could be over?
So I characterize it as a heightened risk of some of those things happening. I don't think that there's enough visibility to say for sure that this year is going to be worse for asset prices, or that liquidity is going to be worse in general. But there's a number of decision points at the current time that increases the likelihood of some of those things happening. So obviously, one of the biggest curveballs and one of the hardest things to predict is what's going to happen with tariffs and how intense is the tariff war going to get. That's a huge variable because tariffs are essentially taxes. And if we see a lot of cross-border taxes pile up, we could see slowing economic activity. We could see profit margins of various companies be hit. We could see just uncertainty delay business decisions, or we could see very minimal of that. We could see a softening of the trade war. We could see a delay of tariffs. You've already kind of seen a pushback of some of these, potential Mexican and Canadian tariffs. Um, Chinese tariffs they're kind of entering in place, but they're not as big as maybe some of the bears feared they could be, at least as an opening volley. Those are a very hard variable to estimate. So putting those aside, then we have to look at what's the Treasury Secretary going to do, and are we going to see a handoff from Treasury provided liquidity and Fed sucking liquidity out to the Fed maybe being more neutral and the Treasury also being more neutral? And I think that's probably a transition we're going to go through this year that will probably have some bumps along the way. So I do think that this is overall time for a little bit more caution, and that some of these rollover risks are present, or at least that we should expect some bumps in the road before the next liquidity cycle.
Okay. So you just used the term liquidity cycle there. So you probably are familiar with the work of Michael Howell over at Cross Border Capital, and he's all about the liquidity cycle. And he's got everybody seems to have their own way to measure liquidity, but by his tracks, um, these are multi-year cycles. And like you, he doesn't necessarily think that liquidity is going to go negative in 2025, but the impulse of its rise is definitely slowing. Just like if you toss a ball in the air, right, as it gets closer to its apex, the rate of change decreases. Um, and there's some other things going on this year, like in earnest, the refinancings that are started and things like that, that he thinks are really going to sort of slow the upward forces that rising liquidity has put on the system. So, like you, he thinks 2025 is probably going to be more volatile. Doesn't necessarily mean it's going to be a down year, but he thinks you'll definitely, if you're expecting another 20% up year in the market, he thinks you're pretty likely to be disappointed. It's probably not going to be that good. Now, he says, look, you got to let me come back on at the end of the year when I have more info. But he's like, right now, he's like, my gut says 2026, probably not a very good year because his liquidity cycle will have peaked in around Q3 of 2025, as best he can tell. And then it's going to be a multi-year down cycle in liquidity. Now, of course, there's a lot going on there we don't know. If the markets start getting into trouble, maybe the Fed's reaction function would be really swift and they'd step in and all that stuff. But I'm curious, as you sort of look out liquidity cycle wise, do you see a similar sort of ending of the upcycle at some point later this year and then some sort of contractionary phase following for a while?
So I think we've kind of had an unusual cycle so far, which is to say that when you look at private sector liquidity provision, one of the ways to do that is to look at our banks tightening or loosening their lending standards
Hmm.
to small and medium and large businesses across the board. Now, historically, when over 40% of banks are tightening standards, we're in a recession. And what was interesting about this past cycle is that that happened. We had over 40% of banks tightening their standards, and then did not have an Enver-defined recession. And I would generally argue that that's because we had a big fiscal component that was larger and more powerful than that tightening of private sector credit. Now, what's interesting is that the private sector credit is now improving in the sense that we're no longer in that kind of aggressive bank tightening phase anymore,
Hmm.
based on most senior loan officer surveys, loan issuance. We seem to be past the worst of it there. So actually, if anything, uh, that's an upward inflection in liquidity ahead. But I do think the physical component is probably at stall speed here, which is to say that partially because of tariff revenue, partially because it at least attempts at cutting the deficit. This could be a flat year or even a slightly down year for the deficit, and so you could see a little bit less of that explosive fiscal, which is basically a tightening of financial conditions at the same time as we see bank lending actually loosen up a little bit. So I think we see a rotation in the source of liquidity, and anytime you have a rotation like that, it opens the door for higher probabilities of volatility and maybe lackluster performance from assets because you have that rotation rather than a lot of things going up together.
Got it. Okay. All right. So we're getting to the main question I was hoping to ask you here, which is, as I mentioned in the intro, your mantra has been nothing stops this train. Um, do you still believe that's the case? Because some of the things you just mentioned there shows that, well, maybe the train might be slowing a little bit. And I know you didn't say, I know slowing isn't stopping. But do you still feel as confident on the fiscal side that nothing's going to stop that train, for the foreseeable future? If so, why? And even if it doesn't stop, do you see that the train could actually have a couple of, some period of tougher sledding than it's had previously?
Yeah, so I'm very confident that deficits are going to remain large structurally, but that doesn't mean you can't have a tightening year. And so I do certainly think that this next 18 months um, is one of the biggest tests we're going to see for the whole nothing stops this train thesis. We have now a advisory group with a lot of power, Doge, that is specifically trying to cut the deficit. And we have what is fairly rare among Republican politicians is the willingness to raise taxes. In this case, they're willing to do it as tariffs and not as the other types of
Yep.
taxes that we normally pay. And so the combination of being willing to increase revenues while trying to get a little bit more aggressive with cutting certainly opens the window for some fiscal tightening here. Essentially, the train slows but keeps going. Now, I think we have a fairly measurable outcome here, which is that so Doge wants to be largely complete by mid 2026, the 250th anniversary of the country. And so that gives us about a year and a half to see, okay, well, what's going to happen along this time? My estimate is that we'll see a lot of optical cuts from Doge, meaning a bunch of multi-million dollar properties that are like, consolidated and multiple kind of programs terminated. But then when you add those together, they will represent a fairly small share of the budget because they're not the big components like Medicare expenses, Social Security, interest expense, overall defense spending, veterans benefits. I think the big checks are likely not going to be affected as much as some of the kind of strong Doge proponents think they will. Even though I think there'll be a lot of smaller line items discussed. I also think the tariffs do represent a revenue source, but I think that when the negative effects start hitting from some of those, should some of those bigger tariffs go into effect, it could potentially slow down the economy. One of the reasons why the U.S. deficit in particular is so hard to structurally reduce is that the US is very financialized. So, for example, there have been times in the past where Canada or Germany were able to significantly lower their sovereign debt to GDP ratios, but their economies were not very financialized at the time, meaning that tax revenues were not heavily correlated with asset prices. Whereas in the US, partially because of wealth concentration, partially because of how we structured our taxes, our tax receipts, the government's tax receipts tend to be pretty correlated with asset prices on somewhat of
Hmm.
a lag. So if you have a flat or a down year in the market, the next year for tax receipts is likely to be fairly weak, all else being equal. And that makes even austerity attempts um, hard to do because you could trim spending, you could try to raise revenues, but then you could end up with a situation where asset prices start to get lackluster, and then your tax revenues don't come in as strong as you think, and the deficit remains fairly wide. So the kind of the summary of all that is to say that this is certainly an 18-month window where there's more risk to slowing the train than there have been for the past few years. But that I generally will take the under on how much it's going to slow by. But this is certainly the time period to watch. And I guess what gets more interesting afterward is if they fail to meaningfully slow the train, how will public perceptions change around that? Will that become a more accepted thesis? Should even this pretty rigorous attempt fail to stop it?
Okay. So it's going to be an interesting 18 months. Um, all right. Well, look, where to go from here next? Let me ask you just to make a judgment question. Uh, so for fiscally minded people like us, it's hard not to at least applaud the intent to be more fiscally responsible. What happens with Doge, who knows? I think your take is probably as good a prediction as any at this point in time. Let's say for a moment that Trump is successful, both in terms of what he wants to accomplish with Doge, both in terms of renegotiating better trade deals for America through the tariffs and securing the borders, with deporting millions of illegals, all the stuff that he's promised and is taking very immediate action on here early in his campaign. Can he be successful with all those? Let's say at the end of his term, we're looking back and saying, "Yep, he accomplished what he was looking to do." Can he be successful in those without some real pain at the start? Because these policies are fairly disruptive, because some of them might be inflationary early on. Um, or can he pull off it just always gets a little better? What trajectory do you think that's, if successful, this is most likely to take?
Yeah, I think so. If he's successful, I would generally expect more disruptions than the market probably thinks, because you'd be talking about the changing of multi-decade trends. And so one of the things I've highlighted before, for example, is how entrenched those trade deficits are. Um, the dollar is the world reserve currency, and that means there's a lot of excess demand for it by entities around the world. And so it tends to make the dollar kind of perpetually overvalued compared to what you'd expect on a trade balance basis or an interest rate differential basis. And that gives us a lot of importing power, which also hurts our lower margin export power, especially our manufacturing. And so
Hmm.
the way that we kind of meet the demand for dollars around the world as the global reserve currency is to run these big structural trade deficits. I think one of the most challenging aspects of the administration is they explicitly want both. They want to reduce trade deficits, but they also want to remain the world reserve currency, even though those trade deficits are ironically what supply dollars uh, as part of that global reserve currency. So I do think that attempts to pull back from that are likely to be disruptive. So I think if things go well, the legacy of this administration be they started the trend of reversing some of these big imbalances, um, and that there were market disruptions associated with that. So, for example, if you do switch more to a tariff model, you could see higher near-term inflation. We've also seen some of the economists that are close to Trump have called out how this is likely to be disruptive early on, likely to be strong for the dollar early on. But then as you get into the process, you could see either a natural or an intentional weakening of the dollar, which is part of that trade balance coming into effect. That's probably the more it'll feel more positive to a lot of markets when you have that weakening dollar because that's basically a pro liquidity action, even though it can be inflationary. So I do think that trying to slow down the trade deficits, trying to change the direction of fiscal deficits, um, is very unlikely to occur without major disruptions. And that's partially because there's a real physical aspect here, which is um, it takes a long time to move manufacturing facilities. They are where they are for a reason. And so there's more cost, there's more time, there's other
Right.
things you don't think about like shipping infrastructure or enough electricity capacity to run more manufacturing or just more energy production and consumption in general to support all that. I would expect generally disruptions. T Basically, the more successful they are at trade deficit reduction or fiscal deficit reduction, you're likely to get more turbulence in asset prices, GDP growth, and that kind of thing, at least for that initial, call it 2 years.
Got it. Okay. All right. So, we have a system that is 2022 aside, um, that is kind of used to, the everything go up game, right? Like, and even 2022, we didn't really have a complete capitulation. The financial advisors that I talk with say it's because it was sort of a slow deflate throughout the year. Kind of at every point, investors were saying, "Okay, is this the bottom? Should I get in now?" We never had the capitulation you see in a true bear market where people say, "I'm done. I'm never touching a stock again." Right? So my question is as we go into this potential period of disruption that you're talking about, how disruptive could it be to asset prices? And I guess the analogy I'll use is, um, if obviously if liquidity goes out quickly, that'll create lots and lots of issues. But I'm just wondering, like, is the market more like a boat where it'll just kind of go wherever liquidity goes, and if liquidity just goes sideways for a while, that's fine, right? Or is it more like a shark, where if it stops swimming, it starts dying? Like it seems like we have so many assets that are just so used to continually going up, even if they just stop going, if that whatever force is buoying them up, if that just even flatlines, that impulse goes to zero. Does that mean a flat asset price, or does that actually mean a sinking asset price because it needs to constantly be fed?
So I think in most years, I would have more um, expectation where flat things are okay, which is to say that things can kind of run flat because that's sometimes what you see during rotations. If you rotate from, private sector to public sector liquidity provision, or you rotate the types of assets that are doing well, sometimes on the surface, what that looks like is fairly flat. Which, it can feel bad if you're on the wrong side of it. It can feel good if you're on the right side of it, but from a broad perspective, it's kind of not a lot's going on. But I do think that to the extent that they're trying to make these first year or 18 months kind of a more of a transitional thing, like structurally, I think there's a heightened risk of if you're not accelerating, you're falling. Um, and so I think that there are these kind of big pockets of risk out there. Probably the one to watch really is part of what part of this kind of everything going up thing is actually pretty narrow, which is U.S. large cap stocks.
Hmm.
So it's not really worth that much for smaller U.S. stocks. It's not really worth that much for international stocks. Um, and if you look at most other countries, a lot of other countries have monetized their real estate more than the U.S. So like there's often higher cost per square foot in many other countries than the U.S. But at the same time, the U.S. has instead monetized the stock market, and specifically, a lot of foreign capital has monetized our stock market. So the whole
Yep.
rest of the world stuffs their capital into U.S. large cap. And if we do start to see a reduction in available dollars for global trade, and more pressure on those dollar liabilities, you could see selling pressure from foreign entities of their dollar assets to cover some of their dollar liabilities. So if we start to unwind this like structural capital shift into the U.S., and we start a multi-year cycle of not having that, that's where you could get pretty significant disruption because you can have what is essentially a balance of payments issue where you can have currency weakening, bond yields going up, and stock prices going down at the same time. And that's kind of a flywheel that's pretty dangerous once it starts.
Okay. So just to be clear, I don't hear you necessarily ringing a warning bell right now saying, hey, folks, that's imminent. Get ready because the tide's going out and all these things are going to start, you know, really crashing. What I hear you saying is get ready for volatility to increase and that this could probably be a disappointing year if you're hoping for another 20% return. But I don't hear you yet saying like assume the crash position. Am I interpreting your current guidance correctly?
Yes, with the caveat that because there's so many moving parts politically and things can change very quickly, they could do an intentional dollar devaluation, which would be probably really good for a lot of assets. They could radically escalate the tariff war, which could be quite negative for asset prices. So this is kind of a headline type of year. I do think this is also a year. One of the more actionable things I think an investor can do is do a valuation checkup on a lot of their assets because when you have structurally rising liquidity valuations tend not to matter. So valuations are generally not going to tell you what 1 year stock performance is going to be. But valuations do matter at inflection points, and they do matter for like 5 year return prospects. And when you look at how assets are priced, so you generally don't see a lot of excess in developed. Like foreign developed or emerging market equities, you generally don't see a ton of valuation excess in medium-sized U.S. equities, although there are some. And instead, some of the valuation excesses are concentrated in the mega caps and not just in tech. And we saw the same thing happen during the dot-com bubble, which is, at when the dot-com bubble was happening, everybody's kind of focused on the Cisco's of the world and the Microsofts of the world and how expensive they got. But at the same time, there were companies like Walmart and Coca-Cola trading at 50 times earnings in the
Hmm.
late 90s. And what happened over the subsequent 10, 15 years was their earnings, kept increasing, went on to double and more, but their valuations got cut in half or more. And so the stock price would basically be dead for a decade. Um, and there are a number of assets like that today, like Costco trading at well over 50 times earnings, Walmart trading at like 40 times earnings. There has been this kind of rush for structural, high quality, blue chip, large cap, even outside of tech. Um, and if you do start to get worsened liquidity situations or rotation in capital, I would be concerned around assets that are, growing earnings at 10%, but then they're trading, like Nvidia, they're trading at like say 40 or 50 times earnings, is where I'd be concerned.
Okay. Um, I appreciate you saying that. So again, just to underline that for folks, a very actionable thing you can do is sit down, go through your portfolio, do a valuation check, as Lynn says, and say, are there things here that are trading at far above historic norms in terms of their key valuation metrics? And if so, then think about doing what Lance Roberts calls, your gardening, right? Start trimming
Yes.
those, and then maybe start thinking about, okay, do I want to hang out maybe more in cash because it's an uncertain year? Or do I potentially want to look at other sectors that are trading at much more normal valuation ratios? You're nodding as I'm saying all this, Lynn. The only other thing I'd add is just if this is something you don't feel very well practiced in, get the guidance of a good professional financial advisor to kind of take your hand and help walk you through all this. Um, okay, so a couple of things. One, you talked about how over concentrated or that high valuations that we're seeing in the large cap stocks, and I think you're mostly referring to the Magnificent Seven, even though, as you said, there are many other companies out there that are trading at rich valuations as well. But the concentration that we see right now in market cap, total market cap made up by the Magnificent Seven is historically abnormal, right? Um, so what those companies generally share is they've been the greatest beneficiaries so far of the AI trade, right? They've had trillions in market cap over the past 2 years, um, been added to their stock price valuations because of expectations on the profits they're going to make in AI. We could have had a conversation, Lynn, 2 weeks ago, 3 weeks ago, about whether that was deserved, right? And whether or not we weren't already seeing what we saw in the dot-com bubble, where hey, the long-term forecast just ended up playing out on a longer path than folks thought, and too much of tomorrow's value had been pulled into today back in the dot-com bubble. And that's why you had these lost decades, if you will, with a lot of these companies, right? Um, just what, a week and a half ago, we had DeepSeek surprise the world, which how disruptive that's going to be to the AI ecosystem, I don't think we fully know yet. You have an engineering background, Lynn, so I imagine that you have a point of view that's more educated than most on this. My general point is just that's introduced uncertainty into the AI ecosystem, right? You now have a product that it is pretty good relative to the other large language models that are out there that apparently was developed at a fraction of the cost, has a lot of software innovation in it, has been made available to the world through open source. And whether DeepSeek, ends up eating the lunch of a lot of the future profits of the Magnificent Seven, maybe, or maybe just inspires, 1,000 other flowers to bloom, and other people are doing, go out there and do a lot of other things with AI. But the point is if we don't, we may not need the capex in the AI space than everybody thought that's been priced into NVIDIA. The other AI players might not be able to make as many profit in the AI trade if all of a sudden AI is going to be a lot more ubiquitous and more cheap to more players out there. You're nodding as I'm saying all this. I'm going through all this context to ask the question, uh, you know, does that introduce a risk factor that is not appropriately priced into today's market? I guess that's question number one. What are your thoughts on that?
So I think so. I would characterize this environment as less bubblicious than the dot-com bubble in the sense that um, the Mag 7, uh, there are differences between them, but in general, they're doing well because they have a lot of earnings rather than just because they have a lot of revenue or
Yep.
clicks, like is what you saw in the dot-com bubble.
Right. The
Um,
eyeballs. Yeah.
yeah, so this is actually backed by profits. And we've actually pretty seen a pretty sharp distinction, which is during, say, the whole 2020, 21 period, lots of unprofitable tech was what was soaring. Kind of things that like ARK would invest in, not to criticize them, but to think of a
Mhm.
type of bucket. Whereas this kind of post 2022 bull market in assets has been more of that hyperscaler profitable type of company that's, soaring to new highs, while a lot of that unprofitable tech is not. So that's probably the optimistic side is that say there are more fundamentals backing up that concentration now than there were in the dot-com era. Where I do think we have similarities is I think the risk is that GPU capex is still more cyclical than people think. I think the risk is people are pricing it now as though that's no more cycles. It's just structurally
Mhm.
higher. We need more GPUs every year now. NVIDIA's beyond cycles. That's kind of the bullish thesis for that space. Whereas the bearish thesis, which I would generally subscribe to, is that we probably will see or are seeing over capex in that area, and then we'll see a contraction period before, potentially going to new all-time highs, but that there probably will be some sort of digestion period. Maybe not as long as like the, optical fiber capex oversupply that happened in the dot-com bubble, but that
Right.
you could get say a couple year cycle of, hey, we have too many of these GPUs. We actually don't need this much capex. Time to kind of digest what we already have. I think that's probably the base case. And the DeepSeek model potentially shows that maybe you don't need as much GPUs as you think for a given level of task. Um, and another thing that's kind of broadly worth considering is where is value accrual going to occur with AI? So in the prior, 10, 15 years of the rise of social media and these big tech stocks, value accrual kind of concentrated in these big monopoly types of entities. If AI ends up being more open and more capital intensive, you could see a situation where their margins are not that great, and ironically, the biggest beneficiary is the consumer that has access to relatively cheap AI to
Right.
expand the things they can do, but that there's no, multi-trillion dollar value accrual to too many companies out there, other than maybe the GPU makers. And I think that's worth seriously considering because when you look around at profitability, very few AI services are profitable, even the most successful ones. So far, the big profit has been the GPU makers,
NVIDIA. Yeah. Yeah.
NVIDIA specifically, and Taiwan Semi and a couple others. Um, and the risk is that as that dries up, we could also see that companies like Microsoft or Alphabet or Meta or others although they're spending a lot on CapEx, they're maybe not getting profits from doing so,
Yeah.
and that they can't raise the price of their products enough to offset the capex, or that they just kind of roughly keep pace with it, so they don't get this, they don't get structural new growth from it. They're just kind of maintaining what they already have.
Right.
And if that were to happen, that's I think a challenge to the Mag 7 thesis, at least at these levels of valuation. So you could see a few years of just them chopping along sideways, letting earnings kind of catch up to what they've already priced, and kind of seeing what the actual sustainable growth rate is here.
Okay, so very well said. And that's exactly the question I think DeepSeek has raised. Now, how is it all going to play out? We don't know. My point, which I think is the same as yours, is just you can make a credible argument that that could be what happens, right? That the lunch gets eaten by many different players and the profit kind of gets bled out of the system. Consumer wins, but there's no big, massive gains for the big AI companies. Um, and yet we really haven't seen any discount in the market for that yet at all. Nvidia a bit so far, the rest no. So kind of where I'm going with this is, um, uh, you know, when you look at markets, you want to look to see what's driving markets, and we talked an awful lot about liquidity, right? But at the end of the day, what really changes, what drives changes in market, it changes in sentiment, right? And it's hard to shift sentiment, right? Because sentiment is kind of a belief. And the analogy that's in my mind here is that you kind of hold on to your belief until you've seen overwhelming evidence that your belief is wrong and you need it to change. So it's almost like chopping a tree with an axe, right? You hit the tree with an axe, sure, a little bit comes off, but the tree doesn't move, right? And the markets had some pretty big axe chops recently. The DeepSeek scare, the trade war, salvos that have come off here, and it has shrugged them off, right? Those axe blows haven't really changed the angle of the tree at all. The concern is obviously these hits keep on coming, and eventually one of them hits the tipping point where the tree starts to topple over. The market doesn't necessarily have to crash, right? It could just go sideways for a long time, as you said, might happen with the AI stocks there. But do you have a concern in a year that you expect to be a lot more uncertain and a lot more volatile that this kind of almost bulletproof market sentiment, I almost want to call it euphoria. And there is something called a euphoria meter that has been pinned to extremes, the past couple months. Do you have a worry there that there is at least a potential that sentiment could shift dramatically from risk on to risk off?
I do. I think that basically, if the tariff war accelerates more than people think, that could certainly do it. Or if these big Mag 7 earnings start coming in softer than expected, because they're either overspending on CapEx and not seeing that translate into higher prices and revenue, or other matters. So I think if that's why it happens. I mean, if that's what happens, it'd probably be along those reasons. Um, I still think that in general, the risk is fairly concentrated. There, we don't really see super broad-based euphoria. So back in 2020, 2021, because you had kind of just throwing stimulus at the wall, you had a lot of things all going up together. Whereas now we've generally seen quality things go up, which is things with earnings, things that are able to grow earnings when other things are not. Like I mentioned, some of the bubbles are in things like Walmart or Costco, which are defensive risk-off assets that are kind of dominating their categories. Same thing with the big tech monopolies. And you've actually seen there's no appetite right now for people to own Brazilian equities or Chinese equities or um, U.S. small banks, or there's lots of pockets where people say, I just don't want to touch that right now. I view it as kind of too risky. Um, and so if anything, there's this kind of risk off bubble. And people kind of price things to perfection. So like Apple's not really grown revenue in like 2 years.
Yeah,
Uh,
Apple, I got to say, just flummoxes me. Yeah.
yeah, and it's interesting because I mean, they have high quality earnings, a decent balance sheet, but right now they have no top line growth, but they're trading like a growth stock. Now it's funny when you think the fact that actually Walmart is trading at a higher valuation in terms of multiples, earnings multiples. So I wouldn't single Apple out uniquely, but there are a number of stocks like that just they're perceived as high quality and they're priced up. And Apple has a lot of exposure to tariff risks.
Hmm.
And so you have a pretty real significant risk profile at a time when the stock is not super cheap. it's rather richly priced. And so it doesn't take much in terms of earnings disruption to cut 20% or more off the market cap for a stock like that. And I think there's a lot of pockets out there. And I think one of the ways to protect against that is some degree of diversification, including into things you wouldn't expect. Like most people wouldn't think to want to hide out in foreign stocks during a trade war. Um, but ironically, some of the risk is probably concentrated in things that are not pricing forward at all.
Hmm.
So people are already pricing Brazil assets as having all sorts of issues, which they do. So there's risks, but there's also kind of priced for risks. Whereas I think the scariest thing is when there are risks, but then the market's not priced for risks, which is what we see in fairly expensive things. So there has, late last year, there are a number of assets that weren't doing well, and then tax loss harvesting would make them do even worse than maybe their fundamentals would have otherwise led them to. And we are
Hmm.
seeing a bounce in a lot of those types of assets here in 2025 now that tax loss harvesting is done. And I think that represents a pretty attractive set of investments to look through because you have there's certain software companies that are, kind of trading at fairly reasonable valuations that are fairly immune to trade wars. There's, like I mentioned, foreign equities that are kind of bouncing up from oversold conditions. So I do think there are opportunities out there that kind of can protect a little bit against this concern.
Okay. And I've had some folks recently on the program. Jim Carson comes to mind, Sven Henrik, who, like you, have been predicting 2025 is going to be a volatile year. And from their perspective, they're like rubbing their hands together on this. Jim is a volatility investor, so he makes more money in years that have more volatility. So that's no surprise. And Sven is a technical analyst, and he's said, "Look, I think 2025 is going to be a great year for trading." He said, "I don't think it's going to be a great year for investors or for investing, but in terms of trading the activity, the really volatile years are great for guys like him, right?" So when you look at a market like this one, I'm curious. It sort of sounded like you said, well, the overvaluations are, it's not market, it's not across the market. It's located in these category leader companies. And one could interpret that as, okay, so we don't have the same kind of broad-based risk that we had in some previous bubbles. But one could also say, well, then that means that if these are the sectors that are really propping up the market and making an oversized contribution to the indices themselves, you have the risk of a small part of the market going down that can take a lot of the market down with it, right? Um, so I guess net net, do you look at this as less of a bubble worry or more of a bubble worry for those factors?
I think it's a bubble worry for those that are heavily invested in U.S. indices. Less of a bubble worry if someone has a diversified portfolio. And that's, it kind of balances itself out because, for the past 5, 10, even 15 years, diversification has generally been punished. It's generally been good to just be like, I'm
Yep.
just long, large U.S. stocks.
Right.
And a
And
lot,
usually large US growth for the most part,
yeah,
but yeah.
large U.S. growth. And a lot of, I mean, whether it's a macro analyst or a frequent trader, they generally don't like markets where just buying a simple index, it just goes up every year because that's a hard benchmark to compete with. They generally like years where like gold is outperforming stocks or emerging market equities are outperforming, U.S. big tech,
Right.
or where markets go down or sideways for a year and alternatives outperform. That's generally where it's easier to make alpha. And so I do think that there's a lot of people kind of there's a risk there that too many people who would benefit from rotation are always expecting a rotation. So that's one thing I always try to caution myself against because if I look over the past 5+ years and say, okay, I got a lot of things right, but I did get some things wrong. What are the biggest things I get wrong? It's generally expecting trends to change prematurely.
It's
Uh,
timing. Yeah.
it's
The
timing,
hard
and
part.
it's which is yeah the hardest part, and it's specifically for me, it's the timing around concentration of U.S. growth stocks into other types of equities. That's been my kind of limiter, which has been offset by the fact that I've been on the right side of fiscal, the right side of assets like Bitcoin or MicroStrategy, getting some of those big trends right, but then always being a little bit more optimistic than I maybe should be about rotations into broader equities. That's probably been my anchor. So I have to be a little bit cautious about that. But I do think that as we look forward over the next year or two, This is kind of a window for rotation to occur, and rotation can be very disruptive for concentrated indices.
Yeah. Okay. Well, look, you mentioned that there are, areas where you see kind of good relative valuations in the market. Um, uh, I think probably the best way for folks to find out where you see specific opportunities is likely to follow you in your work directly, Lyn. So for folks that want to peer through your eyes, see the specific investments that you're looking at and think are most attractive, where should folks go to follow you in your work?
So people can check out lynalden.com, and I have a free newsletter that comes out every 6 weeks, and I also have a low-cost research service that comes out every 2 weeks, where we try to identify some of these specific trends and how we can shift a portfolio around to capture some of them.
Okay. So Lyn, when I edit this, I'll put up the URL to your website on the screen. And also, folks, I'll have a link to it in the description below this video. All right, Lyn. So I'm going to get killed if I don't ask you about both Bitcoin and gold before we're done here. Just as a note for viewers, I focused much more on the nothing stops this train discussion so far with Lyn. One, because I think that's the really important macro trend to understand here. And certainly everything Lyn thinks is going to happen asset-wise derives from all that. And secondly, like I said, when Lyn is speaking at Thoughtful Money's conference in March, we're going to go deep into alternative assets, presumably, or just, Lyn's preferred strategies for protecting against the purchasing power of our fiat currencies. And I'm presuming that those two assets will play a big role. All right, Lyn, so when we're talking here, we're talking on a day where gold is just hit an all-time high, and Bitcoin is back above $100,000 a coin. So I'm just curious, as you, I guess, look through the lens that we just spent the past, 40, 50 minutes discussing about the train not slowing and your confidence that fiscal spending will probably still continue pretty dramatically over the next couple of years, even though it might have a rough year or two as Trump tries to clean house. Um, what are you thinking? Let's start with gold. What do you think about gold's prospects from here?
So I think gold's still in a pretty attractive place in the sense that there's certain periods of euphoria temporarily, but it's not a structurally overbought asset, and there's generally good fundamental reasons for the rally behind it, which is to say that central banks around the world are generally wanting to hold a more debasement-resistant asset they can hold in their own vaults. Therefore, it's resistant to confiscation or seizure. And we see a number of people in China and in other countries where they look around and they say, I don't really like the real estate market, I don't really like the equity market, but gold still looks attractive. So while I generally don't try to predict 12-month price action on gold, I do generally view it as more attractive than bonds, at least as replacing a chunk of bonds in a portfolio. So over the past 5 years, I've been super bearish on bonds and pretty bullish on gold, and that's been a good trade. While I do think that there will be and have been, there will be counter years where bonds do particularly well and gold, chops along flat. I still structurally like gold more than many other defensive assets.
Okay. And let me ask you this. So recently, gold has been rising to new highs, while the dollar has been on a tear as well. And they don't have to, historically, their correlation has been negative. They don't have to trade negatively, and there have certainly been periods where they haven't, but they definitely trade negatively much more often than they trade positively correlated, like right now. Um, I think I heard you say earlier that once we get past the worst of the trade war, saber rattling, and all that stuff, that you could see the dollar weaken for a variety of reasons. Um, if that were to happen, do you think that would that be an additional tailwind to gold? Would they
Uh,
go back to their negative correlation?
I think they certainly could. I think so. When we did a liquidity analysis on different assets, um, gold was somewhat mixed in terms of how much it correlates with liquidity, and a big component of liquidity is that dollar strength, and that's because when there's good liquidity, generally, and that often includes a weaker dollar. Generally speaking, investors flock to risk assets, so equities, Bitcoin, that type of thing. Whereas when there's reason to be concerned, either because liquidity is bad or for other reasons, investors generally flock to, bonds and gold. And so gold's kind of got this mixed bag where on the one hand, it does benefit from debasement and a weaker dollar. On the other hand, it does also benefit from people coming to defensiveness while the dollar's strong and liquidity is not great. So I do think that can give you a second leg. I think it would partially come to how well are big U.S. stocks doing, right? Because if investors say, like, well, if we're weakening the dollar and Bitcoin's going vertical and equities are going vertical again, then maybe I just want to be in there rather
Right.
than gold. Whereas if you have more of that stagflationary environment where maybe, tariffs put prices up, and so maybe you get slowing growth, then you get squeezing margins, and then you get a weaker dollar. That could be an environment where, say, gold outperforms equities. So I would generally need more information to know what to expect in that environment. But I do think that's one of the potential tailwinds for, breaching above 3,000 or otherwise getting higher than we currently are.
Okay. All right. And then shifting briefly to Bitcoin, and let me try to predict, given what you've told me, and then correct me if any of it's wrong. Um, and I guess first I want to start with a clarification. So we have held this conversation all around your mantra of nothing stops this train. And the derivation of that, as I understand it, is you came up with that phrase to describe the prodigious fiscal spending that is going on that you think will continue to go on. I've seen a lot of people kind of grab that phrase and use it to say Bitcoin is the train that's not going to stop. And I understand the relation, right? That Bitcoin, you said, it's an asset that does very well when liquidity is running high and fiscal deficit spending contributes to liquidity. But I see that as a second derivative of your fiscal spending. So am I clear that the train you're talking about when you say nothing stops this train is the fiscal spending? And yes, that should benefit Bitcoin, but Bitcoin isn't the train itself. Is that correct?
Yeah, that's correct. When I use that phrase, I specifically refer to fiscal deficits and mainly U.S. fiscal deficits, which is to say that debasement is likely going to continue, and a lot of it is fiscally driven. Now that does have implications for assets, so that's generally why I like to be I err toward equities over bonds, and I err toward Bitcoin over many other assets. So it has implications for those fairly scarce types of assets. But the phrase itself is not directly about those assets. It's at least the way I use it. It's about the deficits themselves.
Okay. So as long as fiscal spending is contributing to a net increase in overall liquidity, I would think you would think Bitcoin would do pretty well. And I know you've commissioned research that showed, analyzed assets around liquidity. And if I remember correctly, Bitcoin was the one that was most correlated with net positive liquidity. Now, you just mentioned to us that you think that 2025 could be a liquidity neutral year, maybe even potentially a liquidity negative year. 2026, we don't know yet, but I think the Michael Howes of the world could make the argument it might be a bad year for net liquidity as well. So would I'm guessing you're going to say my outlook for Bitcoin over the next, 2, 3 years, I think it's probably going to do all right, but it might have a rough path between now and then because of the liquidity factor.
That's generally how I view it. Yes, I think that, and there's a couple different lenses that I look at Bitcoin through. So one is that tight correlation with liquidity. Um, and so right now, liquidity is kind of flattish. Bitcoin's been chopping along at 100K, above and below, kind of in a consolidation. And so that's making sense to me. Um, I also look at Bitcoin through the lens of regulatory clarity. So there's a lot of companies that wouldn't touch it, but then once it got a spot ETF, and once you have a Trump administration election, they shifted their views on the acceptability of the asset from a tail risk perspective. And then in addition, I look at on-chain indicators. So mainly what I look for is not to use them as trading per se, but to look for major risks. So in years like 2021, 2017, and certain other years, there were on-chain metrics that showed a high degree of euphoria. So my favorite is market value compared to on-chain cost basis. And when that ratio gets really high, there's a risk of a multi-year correction. And currently, Bitcoin's not trading at levels using that metric and similar metrics that indicate a high likelihood of a multi-year correction. Instead, it still looks fairly mid-cycle. It still looks fairly conservative in terms of overall euphoria around the asset, at least the quantitative things I look at. And so I think that the majority of indicators suggest that this cycle still has room to go. So I'm generally bullish with, say, an 18-month view. But I would expect turbulence along the way. And if we have any sort of sharp contraction in liquidity, like we saw recently with some of these tariff announcements, kind of spiking dollar and sell-offs in risk assets, that's when you could see some turbulence in Bitcoin.
Okay. Um, so yesterday we just saw, I don't know what you call it, a proclamation, executive order, I don't know, whatever, but an intent by the administration to create a sovereign wealth fund for the US. Now, that's obviously ignited a ton of speculation as to what's going to go in that sovereign wealth fund. I think a lot of Bitcoiners are thinking, oh, this might be the vehicle for, creating a national Bitcoin reserve. Obviously, gold people are thinking, well, gosh, if we're going to have a sovereign wealth fund, you should have gold in there. Do you have any thoughts on whether the creation of a sovereign wealth fund um, what impact it would have on the prices of assets like gold or Bitcoin?
So that would depend, I think, significantly on how much they end up buying. Um, and so the US has gold. It's not audited, but they have it supposedly. Um, Merely not selling it has an impact on the price. If they were to buy more, that'd be bullish for the price. Bitcoin's a smaller asset, so one government can move the asset price more. Like this past year, MicroStrategy has been a pretty big driver of Bitcoin by being such a large purchaser. For
Yeah.
example, if you were to see Uncle Sam become a big purchaser, like something along like the Lummis bill, for example, that would be massive for price. Whereas if they merely say, hey, we have existing Bitcoin from various seizures, and that with the exception of maybe some seizures that we're going to give back to the rightful owners, we're going to ring fence the assets we already have.
Just sort of
And
eminent domain, they're ours now. Yeah.
yeah, they're ours now, and we're going to call this, we're not going to sell it back to the market. We're going to actually just going to keep this for strategic purposes, and maybe we're not going to add a lot to it. That I think would generally not have a lot of impact on price because it's already kind of priced in. It's already part of that. So I think it would take a fairly large announcement of purchasing these types of assets to really move the price, versus just the optical thing of, hey, the U.S. is officially going to continue holding Bitcoin
Yeah.
rather than selling.
Well, so let's just, and we're speculating here. Let's say the government takes the latter approach and it just appropriates the, illegally confiscated coins to date. Do you think other countries would then feel pressure to follow suit and they might actually have to buy, right? So other central banks say, or other nations say, hey, look, if the US is doing this, we should probably do it too. So could it, even if the US didn't enter as a net buyer, could it force or inspire other countries to become net buyers?
I do think so, and we've generally seen this in the corporate space, which is that MicroStrategy kind of paved the way. We saw fairly small follow through with that from other corporations in the cycle that they did it. So in the whole kind of past 4 year period, we didn't see a lot of other corporations hop on board, or if they did it in a fairly small way. Whereas now, because there's been accounting changes, and because they see the positive example of MicroStrategy get through a full cycle and come out strong, there has been now a more recent flurry of corporations putting it on their balance sheet. Generally, most entities tend to be followers. There's a lot of career risk in being first and wrong rather
Yep.
than following something with a clear precedent. And countries are very similar. So if they see both positive examples on the small scale, so the El Salvadors or the Kingdom of Bhutan, right? These are entities that have had very good fortunes with, having a long-term goal of, stacking Bitcoin on the sovereign level, um, and getting benefits from that and getting benefits from tourism around that, that can appeal to other nations. And then in addition, if the U.S. Is officially kind of saying, hey, we're maybe not going to buy a ton, but we're just officially going to hold Bitcoin. We think Bitcoin's a valuable thing to have a stockpile in, and so we're going to keep what we have. That does legitimize it in the view of many other sovereign wealth fund holders or reserve asset managers. So I do think it could be less career risk for larger and larger pools of capital to say, hey, we think having a non-zero Bitcoin position is prudent.
Okay. Lynn, I could keep going for several more hours, but we're already over our hour here, so I've got to let you go. Um, Folks, first off, if you've really enjoyed Lynn here, as I'm sure you have, please let her know that by hitting the like button, then clicking on the subscribe button below, as well as that little bell icon right next to it. If you want to follow Lynn and her work and look at the specific assets and investments that she thinks make sense given where we are going through this year, be sure to go follow her work there over at lynalden.com. Also, be sure to come back on March 15th for the Thoughtful Money Online Conference to hear Lynn talking about how to protect the purchasing power of your wealth. And to go buy your ticket for the event there, go to thoughtfulmoney.com/conference. Again, if you go buy that now, you'll get our lowest early bird price discount that we're offering. So please go fast. I want everybody to get that lowest price. And if you're one of our premium Substack subscribers, check your email for the discount code I sent out so that you can get an additional $50 off of that early bird price. Last, if you're looking for help, if you are not as much of a DIY person, but are looking for help from a professional financial advisor who can help you navigate this coming year of uncertainty and volatility, as Lynn has laid out for us. If you don't already have a good one who can do that for you, highly recommend you schedule a free consultation with one of the financial advisors that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. To do that, just go fill out the short form at thoughtfulmoney.com. Only takes you a couple seconds to fill out the form. These consultations are totally free. There's no commitments, no expectation to work with the companies. It's just a free public service they offer. All right, Lynn. Great conversation. You're one of the most fascinating people to talk with, and just one of the most enjoyable people to talk with. Look forward to seeing you at the conference. But just as we wrap up here, the people watching this, there are a number of professional investors who watch, but it's mostly just regular people, right? And they're just trying to build wealth for their families. And probably I would say most of them, their top priority is just not to get caught unawares by a market correction. And I think a lot of them share the concerns that you have about the current levels of valuation in this market, as well as the fact that we're going into a year that's probably going to be rockier than what folks have gotten used to. What parting bits of counsel would you have for that type of person?
I think I would say that there's a combination of defensiveness and offensiveness to make sense. So I think that there's a classic phrase that I most agree with, which is that, there's more money lost from people ex worrying about bad things happening, that they're always kind of missing out on gains.
Yeah, it's the
Um,
Peter Lynch quote. Yeah, more people well, more money's been lost anticipating the next recession than was actually lost in it. Yeah.
Yeah, and so I think that keeping that in mind, um, I think a way to manage concerns around that is to say, look, there are concentrated areas, but never forget that there are pockets of cheapness elsewhere. It could be a certain factor, it could be a certain location, it could be a certain asset class, but in any given time, there generally are things that are on sale. And so I think defensiveness tempered with, okay, so I'm concerned about some things, so I'm not necessarily concerned about everything. How can I how can I diversify to a reasonable degree that I'm leaning in to what I think is fairly cheap is probably how I would approach it, which is, conservative risk taking.
All right. Very, very well said. And I think the really important thing here to do as an investor is to be honest with yourself about the type of investor you are. If you're an experienced DIY investor who can do what Lynn just said there, go out and identify the assets that you deem are cheap and figure out the right ones to buy and construct a portfolio around that. Excellent. By all means, you should go do that. If you're a DIY investor, but you don't really feel like you have that experience enough on your own, then find an expert whose shoulder you can look over. And that's people like Lynn. Subscribe to her service, watch what she's doing, and then, follow whatever steps you think are the right ones for you. And if you're not a DIY investor and you just want to get a good professional who can do all this for you, well, that's when you work with a professional financial advisor. So I think a really key thing to do is just be honest with yourself about where do your strengths lie, and then play to those strengths on implementing what Lynn just mentioned there. Lynn, thanks so much. It's always so wonderful. And thanks so much again for being willing to participate in our conference. I'm super excited to have you back in March.
Thank you. Always happy to.
All right. And everybody else, thanks so much for watching.